All right. Good afternoon, everybody. Happy Wednesday. Thank you for joining here this morning. We're going to give everybody just a few more minutes to gather so we can get started on our latest non-QM Mastery Series session. So again, we'll get started here in just a second as more join, but great to see the numbers keep climbing here on the participant side. So thank you for investing your time with us here today. All right, looks like the participants are slowing down, so let's get into this. So first and foremost, my name is Jonathan McCash. I'm the EVP of TPO Sales here at Sierra Pacific, and I want to thank each and every one of you for spending and investing in your time today to learn about non-QM. This is our fourth session for non-QM. So for those that joined us in previous sessions, thank you. And hopefully you've learned something. If not, you're definitely going to learn something here today on our latest fourth and final session here that we have called Investor Goldmine, Winning with DSCR. And this session really is all about teaching you and educating you on how you can leverage DSCR loans to help your investment borrowers either purchase or refinance a property and help them acquire more. And so DSCR is a very powerful product that allows for whether it be an early entry investor, first-time investor, or multi-stage investor, somebody who's purchased 5, 10, 15 or more investment properties in the past or has a portfolio of investment properties, really allow them to cash flow those properties better through a purchase or refi. So we're excited to kind of talk through how all that works in the market. Before we get into some introductions, I did want to just talk about the non-QM market in general. When you look at a lot of the data that exists around non-QM is becoming a larger part of the mortgage market today. So it's something that we can no longer ignore as originators. Non-QM today makes up about 8% of the total mortgage market today, which is a significant size of, let's say, a $2 trillion mortgage market. So I put that in perspective because if you haven't started talking to your realtor partners or your referral partners, your CPAs, your investment property borrowers about non-QM, the time to start is today. It's no longer part of the market we can ignore. Again, it's 8% of the total mortgage market. And so our goal here at Sierra is to educate you on all things non-QM. We think education is the foundation and the base of any partnership and any relationship. So we're here to provide you that education and that knowledge so you can go out there and be successful in the product. So let's get into it. I know we've got a ton of content to cover. Let me just start with some introductions here. First, I want to introduce Brina Hertzler. She is one of our amazing account executives. She always volunteers for these calls and always helps us provide amazing color and commentary around product line. She is a product expert in all things from non-QM to bond. And so we're really happy to have Brina joining us here today, helping us kind of manage the chat and answer some of those questions that come through. So thank you, Brina, for that. And then we also have Will Davis. He will be your lead here through the call, kind of walking you through the slides and educating you about non-QM. Will leads our non-QM effort here at Sierra. And he is, in charge of the strategic growth of non-QM. So he is for sure our resident non-QM expert in all things non-QM. So we're excited to have Will lead this fourth and final session here today around DSCR loans. The one thing I will recommend and ask of the team, we love interaction on these calls. This is what makes these calls special. So please, please, please ask questions in the chat. We will stop, we will engage, we will answer those questions as we go. No questions off limits. So please, if it could be a very basic question or something a little more complicated, please throw it in the chat. Let's challenge Will today to answer those questions and get you those answers. So please make sure you use the chat box throughout the call. We'll stop periodically and answer those. And without further ado, Will Davis, pass it off to you.
Thanks, John. And again, thank you everyone for joining. Let's get into this and share some information and some knowledge. And of course, answer any questions that you have. Just make sure to queue those up in chat. So non-QM Mastery Series, Investor Goldmine, Winning with DSCR Loans. Let's jump into it. What is DSCR? It's just using cash flow from an income producing property to offset the new monthly mortgage obligation, right? Or to cover that PITIA or ITIA. In layman's terms, does the property cash flow, right? can the property pay for itself? That's really all we're looking for here with these DSCR loans. We're not considering any of those other, obligations or debts or anything else. Just does that property pay for itself? Here's some questions to ask, of the loan officer or the borrower. Definitely something that you would want to, kind of cover. First and foremost, is this a, purchase or refi? Is it an investment property, right? We want to make sure that these are investment properties or non-owner occupied occupancies. Are they closing as an individual, a trust, or an entity? Is there entity layering that applies? We'll get into that a little bit more in depth later. Definitely something that we'll want to know, because certain entity layers or structures are acceptable and certain layer entity or structures are not acceptable. Same thing with the trust. If it's a refi, is the property vacant or currently occupied? Typically, we want these properties to be occupied. That way we can show that they, are income producing and that those investors are, able to, generate that cash flow from a monthly perspective successfully. If it is vacant, there are options to still potentially do that transaction. If it's a refi, however, there are, some additional caveats and restrictions that could be applied to that. Is it using long-term or short-term rental income, right? That does change the risk profile of the loan. It's definitely something you would want to know. Obviously, long-term rents with a long-term lease is going to significantly diminish that risk profile, right? Because we're counting on those long-term rents to continue to come in on that agreed upon lease. However, if it's a short-term rental, right, those are, maybe a week at a time or a couple of days at a time, that can create or generate some additional risk from an investor perspective. So we'd have to take those things into account. So definitely something we would want to know. There are additional restrictions that could apply to those loans, just depending on if it's long or short-term rental. And then finally, was the property recently listed or is it currently listed? If it was recently listed and you're just trying to do like a rate and term refi, that may not be an issue. However, if it was recently listed and maybe you're looking for a cash out refinance transaction, that could be problematic just depending on when that listing was pulled off of the market. So it's definitely something that we want to ask just to make sure that we're, providing clear and concise expectations up front for our borrowers. And, something that those loan officers should be aware of when they're, engaging with these different partners.
Will, while we're transitioning over, Julie has a question just asking if we can loan in an irrevocable trust on these programs.
Absolutely not. It must be a revocable trust. No matter the structure, we would need to have a revocable trust at best. Irrevocable trust would not be acceptable. The shorter explanation, for a short explanation on that, just so you're aware, irrevocable trusts can have some issues as it pertains to if they weren't to execute on that loan and the lender then had to go in and try to recoup that asset either through short sale, foreclosure, deed in lieu, etc. It can create a lot of problems to try to get that property out of that irrevocable trust. So just from an standpoint, it adds too much layering of risk for those investors.
Perfect. Thank you.
Great question. Thanks, Julie. So again, who is our target audience? Obviously, we're looking for real estate investors, right? These are all non-owner occupied properties where we're trying to generate cash flow and utilize that cash flow to offset that new monthly expense or obligation. Focused exclusively on non-owner occupied properties or investment occupancy types. And they can be new or experienced investors, just can't be a first-time home buyer, so keep that in mind. Here's some eligible transactions. Property types, we're going to be looking at single-family residences. Maybe it's a single family with an ADU, a PUD, a townhome, a condo, whether warrantable or non-warrantable. 2 to 4 unit properties, leaseholds, and properties up to 20 acres. There's options there, but I would suggest, with that moniker there as it pertains to acreage, make sure you're staying away from rural properties. That is one thing that any of the investors that we have on board here with Sierra Pacific have identified as kind of a no-fly zone. So just make sure that if you are getting into those higher acreage, numbers or amounts, make sure that it is not a rural property, just to prevent any, issues as you kind of go down the tracks with any given loan. And then obviously we're doing purchase, refi, it could be rate term or cash out. We do allow for delayed financing and property buyouts. Maybe a property was awarded through inheritance or some sort of a legal award, maybe a divorce. All of those types of transactions and differences there in transaction type are all acceptable as well. Lots of different things that we can do and accomplish within these, the product enhancements. So eligible borrowers, who are they? What do they look like? Well, U.S. citizens, obviously. We can also do permanent resident aliens or non-permanent resident aliens. Just keep in mind, if it's a non-permanent resident alien, that does apply a little bit of additional risk. And again, you'll hear me say it time and again, as we have on our other presentations, as you modify the risk, sometimes we have to put additional restrictions from an investor standpoint on those loan parameters. So you're going to be held to a maximum LTV, CLTV of 75%. And then, of course, cash out refinances would not be permitted for those non-permanent resident aliens. You can close an inter vivos revocable trust, as we just talked about for Julie's question there. It does have to meet Fannie Mae requirements. And you could do limited partnerships, general partnerships, corporations, and limited liability corporations, or LLCs, in terms of entity, right, vesting. So all of those things, all of those types of borrowers are something that we can accomplish. As it pertains to all of the entity vesting, this is kind of considered what we refer to in the industry as commercial light or business purpose lending. So if you do have those borrowers that want to vest in an entity, absolutely something we can do, within this space. And then I do see Sarah asked a question in the chat. Can we clarify on the non-permanent resident? That would be someone that has like an EAD card along with an eligible visa type for living and working here in the United States, even though they may not be a permanent resident of the United States. And then also, just to kind of piggyback on that, I did see Richard ask a question about I-10. I-10 borrowers are not eligible currently under any of our non-QM programs, including DSCR. It would be held specifically and strictly to U.S. citizens, permanent resident aliens, non-permanent resident aliens, and then, of course, trusts and entity ownership. Thanks for the questions, guys. We appreciate that. So why DSCR loans? Well, it's about the simplest loan you can do. Really, we're just looking at, the cash flow from the property, whether that be on a purchase transaction, those 1007 rents that we see on the rent schedule from the appraisal, or maybe it's a current lease agreement or a recently executed lease agreement on a refinance transaction, right? So it's just a lot easier, a lot faster to get these through, kind of the machine or the cog, if you will. No personal income or tax returns or even employment required on these. So it's a way for you to, complete these transactions without having to worry about a DTI ratio or income or any of that additional documentation. Literally, you leave all of that blank. You don't submit any of those documents that you would normally submit on, maybe an alt doc or a full doc file or a QM transaction. These can also help you avoid, conventional guideline restrictions and limitations. Maybe it's max number of finance properties. Maybe they've gone above that 10 that you could, access through the conventional guides. We have up to an unlimited number of finance properties, just depending on which investor, we kind of sort the file into that we have available. Again, it's no income qualifying, so you're going to avoid things like write-offs and depreciation. Those aren't going to be restrictions on these loans. You're not going to run into those issues with findings and those sorts of things like you might with, again, some of those QM transactions. We also allow for flexible ownership structures. Again, individuals, entities, revocable trusts. We do allow even 2 layers of entity structure for vesting purposes, which we'll get into in greater detail later. And some of these, more complex entity structures that investors or well-versed investors might, prefer to have as a vesting structure for their investment properties can provide numerous different, asset protection and tax benefits. So, as those investors grow in this space, you may start to see more of those more unique or more complex entity structuring. And again, we're going to give you some greater detail on that in some slides here in just a bit. Another great thing is you can conduct business where you are not licensed. So this opens up a significant majority of the country for you to be able to market and capture these DSCR loans, even where you may not have MLO licensing. So speaking of places you can conduct business without MLO licensing, these would be, places that you could do it. We do have a poll that just, popped up for you. So we would like to know, are you currently marketing to real estate investors outside of your licensed state or states? Or are you only focusing on the states where, you have or keep a license? So it looks like most of the responses so far are an overwhelming no, that they only market in their licensed state or states, or maybe neighboring states. So that should tell you, hey, there's opportunity literally knocking on the door right now that you should be going out and marketing in these additional states where maybe you aren't currently, right? Because that's additional business that you could capture and go out and do without having, little to no effort other than just making those marketing efforts, right? No additional licensing, no additional caveats, just go out there and capture it. Now, you will see on the presentation here on your screen, there are all the states in light blue. Those are all states where you can conduct this DSCR business with no additional licensing, no additional requirements. Again, as long as it's a DSCR loan. The states, the 5 states that are in the kind of the darker blue, those are states where you would need an MLO license. It would be required per state regulations and guidelines. Now, there's one hanging out down there, kind of in the southeast, Florida, in that bright orange color. Just keep in mind, if you are trying to conduct DSCR business without a license in the state of Florida, then those borrowers would need to vest or close in the name of a business entity. Then you can still, conduct that business without a license. So again, light blue, operate as normal. You can do that even without a license. The 5 in dark blue, you'd need an MLO license. And then Florida, you don't need a license as long as that borrower is willing to vest or close in the name of an entity, right? So just make sure that, you're capturing this, maybe take a quick screenshot of it. This is opportunity knocking on everyone's door. All right, what are our loan parameters? Well, a lot of information on here. I'll go through kind of the highlights of it, what you want to look for or kind of look at as your min maxes, up to 80% LTV. Now, there's additional restrictions as we saw earlier. Like if you're talking about a non-permanent resident, that might be capped to 75% LTV or cash out refi, et cetera. However, in general, especially on a purchase or a rate term refi transaction, depending on their FICO and their loan amount, you'd have up to 80% LTV is eligible. Loan amounts as low as $100,000, max loan amounts up to $2.5 million, and a min FICO of 640. Again, these are investment properties only, non-owner occupied occupancy types. We do allow for purchase, rate term, or cash out refi. We've gone over our eligible borrower types and spoken a little bit about entity borrowers. I will put one additional, kind of moniker here, if you will. If it is an entity borrower, we do have to have at least 51% of the entity ownership represented on the transaction. So let's just think of it in simple terms. We have 4 borrowers that each own 25% of the entity that we're going to invest in, we would need at least 3 of those, right, to get above that 51%. So if they each own 25, 3 out of that 4 would need to be on the loan, and they would act as guarantors and sign a personal guarantee as a part of that loan package. We do allow up to 4 borrowers on the application, just like any other transaction within the QM or non-QM space. We do allow for up to an unlimited number of finance properties, so you can circumvent, again, those conventional or conforming guides as it pertains to that. We do have options for fixed or ARM, and we also offer either fully amortized or interest-only amortization options. One of the cool things about that we'll get to here shortly in greater detail is if you go interest-only, we could actually qualify you based off of that interest-only payment. Again, options up to 20 acres, but rural properties are not permitted on DSCR, so keep that in mind. I know that's kind of a counterintuitive thing there. Eligible property types, again, we've gone over this, single units, maybe a single family residence with an ADU, 2 to 4 units, condos, both warrantable and non, PUDs, all of those sorts of things, all eligible within this space as well. First-time home buyers are not permitted. They can be a first-time investor. There might be some additional restrictions because, again, that changes your risk profile. But first-time investors permitted, but they cannot be a first-time home buyer. We do have options for reserves as low as 3 months, so a fairly low threshold to jump across there. And then prepayment penalties will apply to these loans, and we're going to go into a little bit more detail on that here momentarily.
Well, we have a couple questions here. So
Absolutely.
Cliff has a couple questions. He asked, which is the best date to do DSCR loans in right now, which my initial tongue-in-cheek response was the one that you can get the most loans in right now, Cliff. But is there any, do you have any intel on that? Like if somebody was going to be really kind of looking into a certain state, is there some that are maybe not touched in as well or are really popping off right now in the nation?
Yeah, absolutely. So Florida is always a big one. So super happy that we've opened up Florida now, as long as they're closing in the name of an entity, right, or a business entity. Texas is another good one. California, there are a lot of opportunities there. Illinois is also another one that's seen a lot of DSCR loans. And then, of course, New York. Those are probably now, again, take this with a grain of salt because that's also where some of the more densely populated, states in our country here. So, sometimes it's a matter of demand, right? There's more people, more demand, but some of those are also just, kind of a tried and true instances of they've always kind of had, a large calling or opportunity for DSCR loans. But I agree with your sentiment, Brina. Anywhere where there's business that you can capture is the right state to be marketing in.
Yeah, and I think the other thing that's really interesting there is that Sierra Pacific is the leading condo expert in the nation in terms of mortgages. And so if you're doing a condo, specifically when you spoke about Florida, I mean, Sierra is the place to go, right? I mean, there's not another condo department in the entire nation that can handle condos like Sierra Pacific. And so when you're doing those in those areas that are going to be condos and some of those other properties, you have that added benefit of not only having Sierra be such a driver in the non-QM space, but being really experts in some of these different properties that nobody else really wants to be experts in. So you've got that great response, Will. Thank you so much. A couple of things is on this one, are the LTVs the same if all units are not rented out on a cash out refi or purchase?
Yeah, so what you're looking at there, let's just say you had a 4 unit and maybe 2 out of the 4 units were occupied and the other 2 were vacant currently, right? And we didn't have a lease agreement on a refinance transaction. So if 2 of the units were vacant and 2, had occupants within them, it doesn't really change your parameters of the loan and what you'd be eligible for in terms of, LTVs and max loan amounts and all of those sorts of things. However, you are looking at the DSCR ratio. So that is going to potentially impact that. What I would say is if those 2 units suffice to cash flow the entire property, you'd have no additional restrictions, no additional caveats. If they don't, then you might need to lower the loan amount so that that DSCR ratio, again, we'll kind of get into this a little bit more here momentarily, so we could successfully cash flow that property. So let's just say, simple math, the new monthly PITIA was $1,000, right? Again, just simple math. Not that I think any, property out there has a 4-unit property for $1,000 a month, but let's just simple math terms, it was $1,000. 2 of those units were occupied, but they brought in $1,000 in total rents. That's a 1-to-1 ratio. You could still do that transaction even with the other 2 vacant. However, if you were in a scenario where maybe it didn't cash flow successfully, whether at 0.75 DSCR or even at a 1-to-1, you might have to kind of restructure that loan to lower the loan amount so your new monthly payment is lower and you could actually meet those, those DSCR ratio thresholds.
Perfect. We have a couple questions on Florida and then business entities. One was probably a quick one on, can a business entity have a foreign partner?
As long as they are not one of the borrowers on the loan, I believe that is acceptable.
Okay.
Make sure you just get with your account executive. We can double check on that. But I believe as long as they're not acting as a guarantor on the loan, so they're not a part of that 51% or higher that we would put on the loan, I think that's probably a possibility. However, and that might be investor specific. However, if they are someone that's going to be on the loan, no foreign nationals.
Okay, perfect. Now, if you're licensed as an MLO in Florida, the DSCR can close on an individual's name, correct? It's only if you're, yeah. So basically, if you're not licensed in Florida, they can only be in the entity's name. But if you are licensed in Florida, it can close in the individual borrower's name.
Meet the head of the hammer. That's it.
Perfect. Right. Okay. And then when you say rural, Sean would like a little clarification. I mean, I think that the issue is there's not a lot of these rentals in rural areas, but could you speak about, does it actually have to be zoned rural, or is that going to be based on what exactly?
The appraisal. That's the first and foremost, is it's going to be what's notated on the market for the appraisal, right?
Okay.
And then you could get a little bit more in depth on it, and you could say something like, are there dirt roads? What does the ingress egress look like? What is the surrounding area and how much is it built up? What's the accessibility to amenities? And all of those things are kind of, coincide with what the appraiser is going to utilize to determine urban, suburban, or rural, right? But that's going to be kind of your end all be all, is what does that appraiser put on the appraisal?
Perfect. All right, we can keep going and then I'll just keep coming back to the questions.
Absolutely.
Thanks.
So we talked about on the last slide at the end, what is a prepayment penalty, or that prepayment penalties do apply. What does that look like, right? What's the worst case for the borrower? So you see a screenshot over here on the right of an amortization calculator. There is the ability to kind of pull up one of these amortization calculators and work out what a monthly amortization schedule looks like. What we have here at Sierra Pacific is 6 months of interest due if for some reason during that elected prepay period you paid off 20% or greater of the original principal balance. So we do have prepayment options between 0, which is no prepayment at all, out to 5 years of prepayment penalty. Obviously, from the investor perspective, the longer they can, hold that loan or that note, the better, right? It, kind of keeps the fires burning, so to speak, in terms of their investment. So the longer the prepay period, the better pricing that you could receive on one of these loans. And the lower the prepay period, the worse the pricing would get on one of these loans. Because again, if you elected no prepay penalty, you could, refi in a reasonably short period of time, and it would take it out of their, pool of loans that they've invested in. So if you were to, have a borrower either do a principal reduction of 20% or greater, or refinance the loan and, completely pay off, then you would be, subjected, again, as long as it's within that prepayment period, 6 months of interest due from the time of payoff. Again, if you ever wanted to calculate the worst case scenario for that particular investor, one of the things that you could do is pull up one of these amortization calculators. I typically just Google amortization calculator. It's the first link that shows up. I put in the loan parameters, kind of like you have in the screenshot here. I switch it over from annual to monthly schedule, and then look at those first 6 months of interest payments. That would be their very worst case scenario. I have found over the years, a lot of these investors will just kind of build these things into their hard cost. So a lot of times, if they are, an investor, they understand how kind of the collective cash flow works, both through acquisition and maintaining the property month over month. So they can build these things kind of into their hard costs, maybe ask for a seller concession because they think they might, prepay, so they can kind of, mitigate some of their upfront expenses and then, save that money to apply to a prepay penalty, those sorts of things. Lots of ways for the investor to kind of get creative as long as they know this up front.
Will, is it a hard or soft prepayment penalty? I'm not really familiar with that term. There's difference hard and soft.
Yeah, so depending on the particular vernacular there in terms of hard or soft prepay, it's going to apply as long as they're within that prepay period. Now, is there a potential, for a soft prepay in terms of, hey, they're going to refinance with the same lender and maybe the same investor, and they, recapture that loan? Could that, potentially be forgiven, something of that nature, or considered? Then yeah, there's the potential for that. So if it's a soft prepay in terms of, selling the property, right? They would still be subjected to that prepayment penalty. Again, whether it's a refinance transaction, the sale or liquidation of the asset, or a principal reduction payment of 20% or greater of the original principal balance.
Perfect. Thank you.
Yep, absolutely. So there's two types of rental income. We've kind of buried the lead here. We talked about it on one of our earlier slides. We've got long-term rents and we've got short-term rents. So how do we calculate those and what do they mean? Short-term rents are obviously going to be something like, an Airbnb or a VRBO, right? Where the lease agreements, if you will, are kind of for shorter periods of time or shorter windows of time. Maybe it's as much as a month, but maybe it's even just kind of a weekend or a week at a time. Whereas long-term rents are going to be someone that signs on for a 6 or 12 or 24-month lease and pays, monthly, right? That's really what we're looking at here. So long-term rents, gross income is going to be calculated using the lower of the executed lease agreement or the market rent from an applicable appraisal. There are options to use the higher rent amounts with additional proof of receipt of rents. The amounts usable varies by product. So get with your account executive if you have a lease agreement that's maybe higher than what you think or what you already know has come in on that 1007 appraisal. So if you have one of those that has a higher lease agreement, there are opportunities to use that higher amount. But if you can't prove the receipt of those rents, for like a purchase transaction that's maybe already got an occupant in it, then we would default to the lower, which is, potentially that 1007 appraisal, especially like on a purchase transaction. Again, it might be difficult to get proof of receipt of rents from the seller. Short-term rents, we're going to be looking at, it does have to be allowed and verified by a third-party property management provider, Airbnb, AirDNA, VRBO, HomeAway, just to name a few. We would need to document that they have been receiving those rents consistently, etc. It does require on a short-term rent that we be at a 1-to-1 ratio on the DSCR. Our other options, as we've talked about previously, we do have options down to a 0.75 or maybe a negative cash flow on that DSCR ratio. So just make sure that if you are going short-term rents, that we are meeting at least that 1-to-1. It is permitted for both purchase and refinance transactions. They do have to be typical for the area and allowed under local ordinances. I know there are some places, especially here in Texas. I know the city of Austin tried to, kind of remove the ability to do any short-term rentals within that municipality. So just make sure that it's, able and legal to have those short-term rentals in that, given jurisdiction or municipality. Refinance, obviously, we're going to, gross rent is going to be based on the lower of the market rent from the appraisal or 12 months of documented short-term rental history, either from Airbnb, AirDNA, VRBO, home away, something of that nature. What I would say is if you're talking about the gross rent noted on the appraisal, it does need to be broken out as short-term rents, not long-term rents. So if for some reason you do have, a short-term rental that you're wanting to execute on, especially a refinance transaction, just make sure that the rents noted on that 1007 appraisal or 1025 for a multi-unit, make sure that they are capturing or that they understand that you need short-term rental income on the appraisal, not the long-term rents. And then purchase, you're going to use 75 of market rent. Again, it's going to be the short-term rents. But it would also need to be, supported by like a 12-month average, right? So just make sure that you've got those, items in there just to, prevent any speed bumps or hiccups along the way. And then I saw a question in the chat from Lisa about how do we calculate DSCR ratios? Well, guess what? We're going to get into it right now. And just before we jump into that, I did see Julie's question pop in. We cannot do a 9-unit. So this is 1 to 4 unit residential properties. Even though it is considered commercial light or business purpose lending, it would still be 1 to 4 unit residential properties currently. We are looking at expansions and options to add like a 5 to 8, but not currently available today. Hopefully we can add that, soon for you. So DSCR ratios, how do we calculate them? And what factors play a role? Well, there's a couple ways to calculate, as we've talked already. You've got fully amortized, which is your gross rental income divided by the PITIA, or principal, interest, taxes, insurance, and association dues, in case anyone was kind of lost in what that A was at the end there. So for a purchase, we're going to use the gross rents noted from the 1007 appraisal. And then for a refinance, we're going to use the gross rents from the current lease agreement with proof of receipt via bank statements, or, if you have a property management company that could give you kind of a rent roll of what you've been receiving month over month, that would work as well. Or we could use a new lease agreement with confirmation of like first, last deposit received. We need at least 2 out of those 3 received. Doesn't have to be canceled checks, but we would need to see it, hit the borrower's account. So typically like a bank statement or similar, showing here's the lease agreement and the amounts that they agreed to for first and last or deposits. And then, we would accept that in lieu of, ongoing lease that maybe they had in effect for a while. Gross rents are then compared to the, proposed new PITIA, and then that's how we would calculate our ratio. So simple math or examples here. Purchased, you had $1,000 in gross rental income from the 1007 appraisal. The new monthly PITIA is $1,000. That gives you a 1-to-1 ratio. Again, we could negative cash flow this. So let's just say the proposed rents were only $750 from the 1007 appraisal, and our new monthly PITIA was $1,000. You could still do that loan at a DSCR ratio of 0.75, but additional restrictions would apply because, again, we're changing that risk parameter for the loan. So we've got to modify, the allowables in terms of, what risk we're willing to take on. And then for a refinance, same thing. You'd have, $1,000 in gross rental income received, $1,000 in new monthly PITIA. That'd give you a 1-to-1 ratio. Both of those scenarios there successfully cash flow. And again, you could use low ratio as well if for some reason you had a negative cash flow. As long as it's at a 0.75 or higher, we do have options for you. Now let's jump into interest only. So this is a great way to kind of maybe push your DSCR ratio above the 1-to-1, or to make something work that didn't work before, right? And the importance of getting to that 1-to-1 ratio is it does modify the risk profile. The higher the DSCR ratio goes, the better the pricing as well. So if we were to pivot to ITIA, we are using the interest only payment. So as an example, we had one that was at like a 0.86 DSCR ratio, if memory serves. We pivoted to interest only, and that pushed us to a 1-to-1. So we could circumvent, some of the other restrictions on being low ratio. and keep our LTVs and FICO score requirements and those sorts of things the same. So we were able to pivot successfully to an interest only, using the interest only payment. And that took us that other 0.14 up to a 1-to-1. I think we were a little bit over, but that did make that transaction work and kind of keep it where we needed it, and offered us, some better pricing in terms of being at that 1-to-1 ratio or higher, as opposed to going low ratio. So what you do for this is you take that, 1007 appraisal on a purchase or those rents received from a current lease agreement. You take those gross rents, you divide them by the new ITIA, interest, taxes, insurance, and association dues, and that calculates your payment. Well, what's it look like? Here's our examples again. Again, simple math, $1,000 in gross rental income from the 1007 appraisal, or maybe on a refinance from the rents received, $1,000 new monthly ITIA or interest only payment. That would get you to your 1-to-1 ratio. And just a little bit of additional conjecture here on our interest only options. If you were to go like a 30-year fixed interest only, it would be a 10-year interest only period. And then the final 20 years of the amortization would be at your fully amortized payment, but you're going to be able to calculate the DSCR ratio off of that interest only payment, from that first 10 years. So let's get into some acceptable vesting structures. We've talked about a little bit of that earlier. So now let's kind of, give you some examples of what they look like, right? So what we're looking for here is, hey, how can I actually structure these deals and scenarios, and what's acceptable? So obviously, we've already talked about it. We've got, John and Jane Smith, borrower, co-borrower in this situation. We're going to vest in their individual names. Absolutely something you can do. No worries or issues there. This is absolutely an acceptable structure to vest in the name of an individual or individuals, right? Here's another one. John and Jane Smith as trustees. The Smith Family Trust, revocable. Remember, it's got to be a revocable trust. So this is absolutely something we can do. Absolutely an acceptable structure that we could vest in, as long as it is a revocable trust. Irrevocable would not be acceptable. Jump into the next one here. We've got John and Jane Smith, and then the Smith Real Estate Holdings, LLC. Again, that's one layer of entity ownership. They're investing in the LLC, and they're the owners of it. Absolutely something we can do. Just make sure, again, maybe John and Jane Smith have a partner, but John and Jane Smith own 51% or greater. We could vest in just their name, in the LLC name, with just the two of them on the loan, leaving that other, 49% or less off of the loan. But definitely something we can do, vesting in an LLC with one direct line to, the owners of that entity. Here's a slightly more complex one, right? So John and Jane Smith, who have a family trust that's revocable, and then Smith RE Holdings, LLC, that is owned by the trust, right? Unfortunately, because we are adding a trust into entity ownership vesting, this would not be acceptable. Even though it's only got one layer of entity ownership, it is not acceptable because we have now layered it with a trust. Long and short of that, kind of like we went into earlier with the revocable or irrevocable trust, when you combine the layering of a trust, whether revocable or irrevocable, with an entity, that creates a very complex structure. It can also, be kind of easy for ownership to be masked or hidden. So that is just risk that, our investors are not willing to take on. So would not be eligible for this one because we have added a trust along with entity ownership. So here's an even more complex one. We have John and Jane Smith, who own holding company S Corp, and then they have 3 series LLCs, Series 1, Series 2, Series 3. Maybe they have, 1 or 2 properties in each of these series LLCs, and they've done this structure either for tax mitigation or, asset protection. If someone was to get injured on a property, they could only come after each of those series LLCs, as opposed to if you held them all in your S Corp, they could come after the entire S Corp. So it gives some additional protections to those investors. In this instance, we have 2 layers of entity ownership. They're going to vest in the Series 3 LLC that's owned by the S Corp, and then the S Corp is owned by John and Jane Smith. In this instance, this would be an acceptable entity structure. We have 2 layers of vesting. There's no trust involved in the entity hierarchy, so we don't have to worry about that. And it goes and filters up after the 2 layers into the owners of that holding company. This would be absolutely something that we could do. John and Jane Smith would be on the loan. We would vest in the name of the Series LLC. We'd provide documentation about the holding corp to show that chain of entity ownership or those 2 layers. Absolutely something we could do in this instance. Now we'll add another layer of an even more complex scenario. So John and Jane Smith, we've got the Smith Family Trust that is revocable, and then their holding company, which is an S Corp, and then the same 3 Series LLCs, 1, 2, and 3, we're going to vest in Series 3 LLC. This would not be an acceptable vesting structure because, again, we have added in a trust in the middle of that, entity ownership layering or structure. Now, it's still only 2 layers of entity ownership, but because we have involved a trust along with entity layering, whether it's 1 or more entities, that would make it ineligible. All right, Brina, I think you had some questions, and I have a question while you kind of compile those to ask of the chat. We've got another poll for you. What we'd like to hear is just some feedback, and we've got a few questions here for you as to, hey, what have you guys, picked up on or learned from, this mastery series? Is it, you learned more from, marketing and how you should be marketing to non-traditional contacts? Is it supplemental sources of income as it pertains to alt or full doc and all the things that we could do there? Is it the ability to combine income sources from the same or multiple borrowers? Or is it something maybe that we learned from this one as it pertains to, ability to originate DSCR business in 45 states where, you might not even be licensed as an LO? These are multiple choice. So if you've learned something from each of the trainings, select them all. If you only attended first training today, this is the first of the mastery series you've taken part of, feel free to just answer that DSCR, business in 45 states where you're not licensed. We appreciate the feedback, and we'll take this and it'll kind of help us, drive more into some more information that we need to kind of share out there with you and our, broker partners to make sure that you've got all the tools and equipment necessary to capture as much of this business as possible. We appreciate the feedback, guys. Brina, I am ready for questions if you've got any more.
You're always ready, Will. Thank you so much. Okay, so Eric has a scenario here where he states that he has an investment property where it is owned in a trust, and his partner and he both have ownership as a trust. Yep. So it's a beneficiary, my trust, his trust. I think the question is, would that be still a 2-layer since there's no S Corp?
No, so if you have any sort of an entity at all, right? It could be an LLC, an S Corp, a partnership, whatever the case may be, involved with a trust, that would be an ineligible type of vesting structure. Now, if it's just the trust back to the trustees, of that trust, that's absolutely something that you could do as long as it is a revocable trust. If it's an irrevocable trust, non-starter, can't do it.
Okay. I believe that that's what he's saying, is that basically is 2 trusts. I'm assuming that's revocable since we've mentioned that a couple of times, but it doesn't have any mentions of LLCs and S Corps. And so it looks like that would be just 2 layers just because it's he and his partner and then the trust. So that's great. Sarah had asked the question, just to clarify, we use 100% rental income, not 75%. Obviously, the question there comes up from normal conventional investment loans where you would basically take the rental income from the 1007 and then you would apply that 75% cut. You do not do that on DSCR loans because that is your income, right? You're qualifying off of that income. And so you would, yes, Sarah, use the 100% on that.
And then remember too, just remember as well, just a little bit of conjecture here. remember as well, we're not looking at any of their other monthly obligations. There's no DTI calculated. They don't even have to have an income source or an employer on there. So we're not looking at any of their other investment properties or their monthly obligations associated to those. We're looking at gross rents from the subject, 100% of them, compared to our new monthly PITIA or ITIA.
Right. Okay. And so that was one of the other questions here that I actually have put on another place, but I'm going to go back because Kim had asked, do we list all other real estate owns? Do we include their current primary residence PITI? So Kim, that answers your question that no. That's why when Will said that these are like the easiest loans, they really are that simple because you're qualifying truly off the rental income from that property. Okay, so we're going to go back down to some other questions that we had.
I will add one more thing in there, Brina.
Yeah, please do.
You will list the REOs because that helps us understand their investment experience, right? That's how we can confirm that they are an experienced investor or maybe a first time or novice investor, right? So that can help us, kind of differentiate whether they are an experienced investor or are not an experienced investor. So you'll list them. However, all of the monthly obligations and debts associated to those REOs, you don't have to include in there because, again, we're not looking at them. We're not calculating that in your DTI ratio. We're not worried about that for reserves or anything else. Everything is based solely from an income perspective, the DSCR and reserves. It's all based on exclusively and solely the subject property.
Perfect. There were several questions about getting access to marketing materials in this recording. This recording will be sent out probably in the next couple of days to everyone that attended to this. And then if you have questions in terms of marketing materials, so you can specifically reach out to your account executive. They'd be happy to help. We've got an incredible marketing department. We had the question of, can you rent to a family member?
No, you would not want to be renting to a family member.
All right. And then the next question Gail has is, if an MLO is working under DRE and is 1099 and is licensed to, say, the state of Nevada, but the brokerage where the MLO is licensed hanging their DRE and MLS license is not licensed in Nevada, can the MLO still originate a DSCR loan in the state of Nevada?
So what I would say on that one, is because of the granularity of that particular scenario, let's look specifically into the Nevada guidance and just make sure that we're not missing anything. I would say it's possible there are certain states that have that type of structuring. Reach out to your AE. We'll absolutely get you an answer to that question, 100%.
Perfect. Another question that we had was, can you advertise DSCR loans nationwide, including the states that require licensing? And if so, what would you add to the post for compliance purposes?
I would strongly suggest if you are marketing, I would contain it to the 45 states where DSCR is eligible without licensing. I would never suggest that you market in a state where you need licensing of any type that you don't have it. So as long as you have licensing in that state, or it's one of the 45 states that are eligible to capture DSCR specifically deals that you could, capture in those states, I would say absolutely you could do your marketing efforts there as long as it's specifically for DSCR loans. But I would not recommend anyone to market anything in a state where you would have to have a license and you do not hold one.
Sure. Well, that concludes our questions.
Awesome.
Yes.
Thank you very much, guys, for your participation in both our polls and the chat. Thank you, Brina, for jumping in and answering our questions. Yeah. I am now going to drink some water and rehydrate after all this talking that I've done. I'm going to pass it over to John McCash, our SVP of Sales here at Sierra Pacific Mortgage, and I will let him wrap up and close us out. Thank you, guys.
Thank you, Will.
All right. Well, thank you, Will and Brina. Let's show them some love in the chat if you really appreciated the work here that Brina and Will taught us and educated us. Send a quick note in the chat. I'm sure they'd love to read those and see those. But thank you again for joining us today. Thank you, Will. Thank you, Brina, for all the knowledge that you've been able to share during this mastery series on all things non-QM. And there's more of this to come. So we are planning on continuing this effort because we believe education is at the heart of what we do as originators in the mortgage space today, educating consumers and home buyers and all their options available today. And again, there's no product like DSCR in the market today. It's a product of today, right? Between short-term rentals, long-term rental income, giving people the ability to tap equity on existing properties or helping an investor acquire more properties. This is a very simple way to qualify a consumer. We even see internally many borrowers who decide to go DSCR versus standard conventional, simply due to the sheer paperwork required to qualify an investment property loan on an agency guidelines versus going DSCR. As Will indicated, simply it's the cash flow of the property. There's no other debts, no other property payments that are required. It is the cash flow of that property that the borrower is using to qualify on that particular loan. So it's a simpler way to qualify. It really streamlines the experience for your borrowers, and gets them either, again, into that home they're looking to acquire as an investment, or refinance or cash out an existing home they currently have. So again, if you have questions, please make sure you reach out to your account executive. We have an amazing team of AEs that are very well versed in non-QM, and you also have Will Davis, and I'm sure Will won't mind me saying this. Will is available to all of our account executives and to all of our clients as well. He is available. He's accessible. If you need him for a one-on-one training, you need some help, contact your AE, contact Will. We will jump on it and we will help educate all of you on non-QM. So again, a quick thank you for again spending the time with us today and during our Mastery series. It's really been a phenomenal series here we've had in the last 4 months. We appreciate your time. We appreciate you. Please reach out to your AE and inquire more about DSCR and non-QM loans. Thank you all, and enjoy the rest of your day and the rest of your week.